Hello, everyone. Good, good afternoon, and welcome to the today's Lunch and Learn. Typically, when we do these webinars, we've been doing them usually in the evening, starting at 7 p.m. So this is sort of the first one for the year, 2024, and the first time that we're doing them at the lunch hour. So Happy New Year, and glad that you're able to join us. What we're going to be focusing on, it is customary that at this time of the year, you're in January and heading into February, a lot of conversations evolve around tax and tax strategies. But majority of them tend to focus on the conventional approaches, the conventional vehicles. A lot of RSP conversations, for example. But what we're going to do today is to also look at some of the ones that typically don't get much focus, may not be in the mainstream or in the awareness, and that's essentially what we want. We want to sort of shed some light, bring some awareness to something that is unconventional. So this is a brief agenda. We want to keep it really tight and end by 1. Something that we're actually going to do for today, though, is we intend to have a more time towards the Q&A section. Because of the nature of the topic, we feel that getting to that Q&A section will be much more valuable for you, the individuals, and trying to not do too much of an information overload. To help us to understand who's in the audience, we'll do a bit of a slider poll, and then I'll sort of do a bit of setting the stage, and then get Munir to focus on some case studies in terms of scenarios where this is being used to assist individuals in saving on tax. Okay, so that is the plan for today. And if you are joining this webinar for the first time, my name is Orlando Lopez. I am an investment advisor and financial planner here at RBC Securities. I've been here now for about over 4 years, but been in the industry for much longer. Practiced initially at a previous organization, and I've always used the different platforms that I have to share my knowledge and my learnings about finance. So been doing that using these webinars for going on 4 years now since COVID. And also I share my thoughts and ideas in newsletters in any platform that I get the opportunity. Very involved in the community as well, and also busy with 2 little ones, raising a family with my wife. So today with me, joining me is a Munir. Munir is from Canadian Benefits Associates, and he specializes in actuary and specializes in the space around retirement solutions. So it's a very niche area. So really, I'm honored that we'll have his knowledge and his expertise on this webinar today. And to get things started, as I mentioned, we'll start off with just a few questions on a poll, which you'll be able to access if you have a cell phone handy. You can take a picture of that QR code. It will bring you to the page, or you can open up another browser, go to slido.com, and input the numbers 3148077. So I'm going to pull that up here as well for us and start off with the very first question. Okay, so first question is, which of the following best describes your reason for joining today's webinar? And let me just, so is it more so for your own awareness, yourself? Is it predominantly based on your area of expertise and work? If you're an accountant, then this might be valuable for the individuals that you're helping, right? So, so far, 50-50. Okay, that is helpful. All right, so move on to the next question. And again, the slido.com and the code 3148077 is how you can get into the poll. So the next question is, which of the following account types do you have personal experience opening? This actually allows for more than one to be selected. So have you personally had experience opening or dealing with an RSP, tax-free savings, an RESP, registered education savings plan, and retirement compensation arrangements? So RSP, TFSA, RESP, so that third one should say registered education savings plan, and RCA is the last one. Okay, so nobody so far for retirement compensation arrangement. All right. And final question, have you ever put money into a trust account? Like, have you ever dealt with a trust account and deposited money into a trust account? Okay, the majority have not. Okay, so the majority has not dealt with a trust account or put money into a trust account. All right, that is helpful. And all right. So as you saw in the description of the webinar, we sort of talked about the link between a tax conversation and Jose Bautista. I'm sort of stating that he's a baseball player who made tax planning cool. And we're going to talk about the tax planning strategy that was used while he was, playing for the Blue Jays. And how that benefited him, and how that can also be used for some individuals. Because again, it's something that can work, but there are certain parameters that need to exist. And I've included on this picture as well, because we're going to use that just a little bit in the example. One of his contracts was $18 million that he earned in one particular year. So if we were to look at and we were to say, okay, what if Jose Bautista, one, looking at that contract that Sarah says, that's a lot of tax that I'm going to be taxed on with that amount of income. And the options, traditional option, an RSP, retirement savings plan, which allows for tax deferral. So what I want to do is we're going to just kind of take a little bit of a look at, well, what if he used a retirement savings plan, right? And this is just a sort of a napkin calculator I like to use every now and then. It is from Ernst & Young, and what it allows is really quick and dirty to sort of say, okay, at a certain taxable income, if you were to put $30,000 as an example towards an RSP as a deduction, how much would you save in taxes, right? So it's very few assumptions. It's just that taxable income, that T4 income, and the amount. And by the way, an important thing to point out here is the maximum contribution room for a year currently is 30,000 and change, right? So unless somebody carried over contribution rooms, they'll have more to do catch up. But each year, 80% of your income up to a maximum of 30,000. So what I want to show is at 100,000 income in Ontario, the tax savings for that year will be 9,582. Then we do 200,000, that increases. So if somebody's earned income is 200,000, they contribute 30,000 towards their RSP, saves them 14,000. We continue 300,000 income, 16,000 is saved. And if we were to keep going, 400,000, it still stops at 16. If you go to 500,000, it's still 16,000. At $1 million in income, still 16,000. And you can kind of extrapolate that. Wait a minute. As you keep going, getting closer to the baseball salary, 100,000, and let's now put that 18,000 from Jose Bautista. You can kind of see why it was beneficial for him that someone in his camp was able to say, hey, there's another option out there, right? Because if you were to only use this vehicle, the RSP, you will be limited because there's only so much you can deduct. There's only so much you can put towards this vehicle, right? So this is a very extreme case. Again, not everybody's a baseball player, so it's it's a really exception. But you saw that even at that, 400,000 or 500,000, you start to see that cap, that you're not actually able to see much more tax savings, right? Because you're capped at what you can put towards an RSP. So if we go back here, and what I want also, I'm going to tie this back into one of those polling questions. So when a number of people said that they've got experience with opening RSP accounts, but it didn't coincide with the final question with how many persons have actually put money towards a trust. It's sometimes not in our consciousness that an RSP is actually a trust account. So if you did not realize, if you have an RSP, you've set up, you do have a trust account, because, and what I've got on the screenshot here is on the left, I just pulled one of our own documents that indicates, part of when you open an RSP, there's usually a number of documentations that are signed. And one of them, this says RBC Securities, Retirement Savings Plan, Declaration of Trust. And it goes into all of the different rules and the parameters around contributions and withdrawals. There's these specific rules on, who's got the responsibility, whose responsibility is it to make sure that, the amounts required to be taken out by 71 is done, right? So there's different things that are part of that trust agreement. I even pulled one from, across the street, quote unquote, right? So you sort of see I've highlighted even, BMO, Retirement Savings Plan Trust Agreement. So want to put that out there, that we're not as intimidated, or to reduce the intimidation factor around trust accounts. Because if you've got an RSP, you do have an account in trust for yourself, right? On the right, that is what we're going to call a more customized trust. And you'll see this, retirement compensation arrangement, trust agreement. The difference, though, is when these are set up, they are not cookie cutter or standardized the way RSPs are. So the way an RSP trust agreement is, it is mass produced. Institutions like RBC and our competition, they can put out a whole bunch of them, throughout the day, because they're really cookie cutter. I want you to think about this in the context of something else that we're familiar with, which is very customized, mass produced. Good old McDonald's burger, right? So a Big Mac, Whopper, whichever one it is, very standardized, which has its pros and cons. They're efficient, they're fast, and that's why they can mass produce them. Very different from on the right, something that is much more customized, right? So, if you want to replace the bread with lettuce, there you go. If you want the meat, the beef, to be, coming from a cow that was a vegan cow, and you want to make that cow to have had good relations with the fellow cows, you can go as customized as you want, right? So that's sort of what I want you to use as that analogy when you're thinking about an RSP, which is a trust account set up for one, retirement savings, as opposed to a retirement compensation arrangement. Now, I just use the terminology retirement compensation arrangement, and I also try not to overuse it, because I don't want us to get caught into the technical terminologies of these, right? I want the bigger picture concept to kind of come across. And as I'm talking about technical terminologies, RCA, and again, acronyms, banks, we like to use acronyms, sometimes, not my favorite, but a retirement compensation arrangement is the technical term that will be used if you're speaking to an accountant, a lawyer, or CRA, right? They'll know what you're talking about. Sort of similar to if you are in the medical field there are certain terms that here's what everybody calls it, here's what the medical term is for it. So, if I'm seeing my doctor, I can probably say, doctor, the honest truth is these high taxes are a real pain in the gluteus maximus, right? What is that? Well, it's a medical terminology for, and again, don't look that up or don't have your children look that up, right? But you kind of get the drift of what I'm trying to say. So that's a technical term, right? And the technical term for that vehicle that Jose Bautista used was a retirement compensation arrangement. And let's kind of touch on that as well, because what kind of brought it to the limelight for a lot of folks was because there was stuff in the news about his use of the retirement compensation arrangement and a little bit of back and forth with CRA around its usage. So we want to put that out there, and I want to sort of share, what were the issues at hand. I think it's still sort of in limbo, but I wanted to touch on what were the issues that sort of came up, and then that will kind of help to sort of frame and to understand, how to properly use these vehicles, right? Not much different from, when tax-free savings came out initially, there's a lot of folks that overcontributed, right? So there's parameters, there's minimums and maximums that are set up for these accounts, right? And a lot of folks just innocent mistake overcontribute to their tax-free savings. So what happened with Jose Bautista and the baseball players? What occurred, or what is at play, is for some of them, and I kind of have them in red, CRA sort of relates to how much time, two of these players spent each season in Canada and in the US. So as a international globetrotting baseball player, you're playing against a lot of teams in the US. It's very easy to see why there's not much time they'll spend in Canada. Not many of them are Canadian, so when they are in their off season, easy to see they're going to be outside of the country. For anybody who is not a baseball globetrotting person, you live in Canada, that's not usually a big concern, right? In terms of how many days you are in the country versus other countries. So just wanted to put it out there. The other area specific to Jose Bautista was in relation to more so the withdrawals that were made. So, was it too much that was withdrawn that indicates this is not really being used as a source of pension income that's being spread out? It's kind of being used like a piggy bank. You're just pulling everything out all in one. So again, the parameters that are, need to be respected by the individual who owns the account and also the entities that are, acting as trustees. So that's one of the things that I wanted to point out. And at this point, to really put some light on it, put some meat on the bones, wanted to sort of touch on some other kind of cases, other scenarios that RCAs or retirement compensation arrangements are used, because again, we don't have any baseball player on the line, and I want this to be something that you can see how it could be useful for yourself or for individuals within your circle that might be clients. So I'll hand it over to Munir. And Munir, if you don't mind, in your experience, because you've dealt with a lot of RCAs in terms of getting them set up, walk us through other examples that are outside of this case. And again, I only use it initially to start it off because it was, everybody can sort of identify or know who the Blue Jays are, Jose Bautista. But let's talk about the more common sort of scenarios that are in this sort of realm for RCAs.
Thanks, Orlando. Thanks for the.
No problem.
Okay. Can you hear me?
Yeah, I can hear you.
Okay, perfect. All right, so let me just throw some slides up. Thanks for the lead into it. Give me 1 second. Hopefully you can see the slide.
Yep, I can see it.
Perfect.
Wonderful.
Great. Thanks, Orlando. So what I'll do is, I think Orlando did a really good overview of what these financial products are. So just to give you a bit of a background on what these financial products do, is what they allow you to do is significantly contribute to a trust account, which means the corporation would get an immediate tax benefit or tax deduction for these contributions, and the individual, the beneficiary of that would be the member, would not see any taxation to them until the money is taken out at retirement or at a later date. So just a quick overview of what an RCA is. It's usually set up for owners, executives, or key person. They are a type of a pension plan, tax savings vehicle. Some of the benefits are, and I'll walk through a couple of case studies to sort of put some real life examples through. But an RCA is basically the ability for an individual or the corporation to fund from current contributions dollars that are significantly higher than the dollars that you can put into the RCA. The dollars that you can put into an RRSP.
And that's that last line there. No limit on T4 income, that 30,000 part I had mentioned earlier. So that's kind of, I guess, the limitation with RSPs, while this allows for that limitation to be sort of, I guess, pushed aside because you're not limited to that.
100%, and that's a key point there, because for an RSP at that dollar level, at 18%, you'd be capped at a little over $175,000. So if your T4 income was $175,000 or more, you're capped as to what you can put in the RCA. In the RSP. In the RCA, there is no limit. You know, if you're making $200,000, $300,000 in T4 income, $1 million in T4 income, or in the case of the professional athletes, $15 million a year, the contribution that you can put into the RCA is based on that T4 income. So it would be significantly higher. The contributions are flexible or can be designed. The RCA can be designed, as Orlando mentioned, these are customized plans. They can be designed to afford flexibility to the corporation. So, if you're an owner running this RCA and you had a really good year, you could put in larger dollar amounts and get a tax deduction. In other years where you may be, either the income is lower or you have significantly higher, or you have other investments that you want to do that year, you can make $0 contribution to the RCA or make a smaller dollar contribution to the RCA. So there is significant flexibility. Also, with regards to withdrawal from an RCA, is you do have a lot more flexibility with regards to withdrawal. It can be withdrawn as a lump sum. It could be withdrawn as an annuity over a certain number of years, 5, 10 years, if you wanted to spread it out for tax purposes, or it can also be withdrawn as a lifetime stream, so payable over life income. I think the comment with regards to Jose Bautista, one of the concerns that they had was, as Orlando rightly put, was that more of a piggy bank, in the sense of, you don't want to be taking out money at $200,000 and $400,000 next year and then zero. So they don't have a problem withdrawing a lump sum or a regular stream of income, whether it's for a lifetime or over a certain period, but it's more like a piggy bank situation. Another big advantage with an RCA is it is a beneficiary trust. And, the reason it's set up as a trust account is the corporation gets an immediate tax deduction when the money's put in, but the beneficiary, the member, the individual who that money is being put away for, doesn't actually see the tax implication until the money is withdrawn. One of the other advantages of being a beneficiary trust, it does provide enhanced creditor protection. So in other words, if the company gets sued, because this isn't a beneficiary trust, the money that's already been contributed to the RCA trust does not belong to the corporation, and it usually affords significant creditor protection. Any questions before we get into the case studies?
Or we'll do the Q&A on the tail end, but definitely great. I wanted you to touch on the key person because what I want also for people to also realize is that it is not only something that gets utilized for, ultra high income. There are cases which Moni is going to touch on here where an individual working for a company, they're not an executive. You know, as an example, they're making 150,000. There is a case to set one up for this individual. And that'll be a good one to touch on, Munir.
Absolutely. So key person, so one of the issues that companies have is they have individuals within the organization, within the company, that would cause a lot of heartache, a lot of problems for the business if they were to leave. You know, so one of the options with the RCA is it can be designed where the RCA becomes, the way the RCA is, as the person gets older and older, and as the person has more and more service with the companies, the level of that benefit increases. So if the individual were ever to leave, say 5, 10, 15 years down the road, it would be very difficult or very expensive for any other company that was going to take that individual on to replicate and provide the equivalent level of benefits that the RCA had already accumulated. So that in itself becomes, for that individual, very difficult. Now I'm talking about the employee here, the key employee, it's very difficult to leave because they would be leaving on the table significant amount of retirement benefit. As an owner or as a corporation that has a key person, that's a great tool to have, for especially for your key employees. Now, the level of income we've used is 150. It doesn't mean it has to be 150. It could be lower. It could be higher. But that does afford you that ability. So the level of benefit, if somebody was with you for 15 years and, you know, they were 5 or 10 years away from retirement, joined another company, they would not be able to provide the same level of benefit in the same tax-effective manner that they have accrued because they do not have the past service. So one of the advantages with an RCA is the longer the service of the employee, the better or the higher the benefit that can be provided through the RCA. One of the other advantages also with the RCA is it does offer flexible vesting provisions. So when we talk about vesting provisions, you can have the ability that the earned benefit within an RCA, again for a key person for retention purposes, is you have the ability to not have the benefit earned or the benefit owned by the key person until certain requirements are met. For instance, somebody could be 55 with 10 years of service, could be age 55. So that also helps with retention. So if you have a 52-year-old key person who's been accumulating benefits within the RCA for a number of years, if they leave before a certain specific date or time, they may be leaving significant amount of retirement benefits on the table. And that, again, works as a really good retention tool. Now, there are a number of other situations.
Who normally brings this, initiates this? Is it usually the business owner initiating this to sort of say, okay, I'd like to provide this for my, you know, very important employee of mine? Or have you seen where the employee brings it to the attention because it's a bit of a win-win? Yeah.
Agreed. I think in the sense of for the key person, it's usually the employer that's bringing it up, the owner, because they're worried that, you know, we're paying somebody $150,000. They get offered, you know, $180,000 or $170,000 by a competitor, and they leave, and they're going to leave. So they're always that's always a worry. Whereas, you know, you have an RCA benefit set up and you're funding it. The level of benefit that RCA can provide, if they were to leave and go to a separate company without the past service, and for them to provide the same level of benefit, it would be significantly higher than the $20,000 or $30,000 of benefit that they'd be leaving on the table. So, you know, when they would do an apples-to-apples comparison, unless the competitor was willing to pay a significantly higher dollar amount to cover off the lost savings of the RCA or the lost benefits earned under the RCA, that key person is not likely to leave. So it's usually the key person is usually the employer coming to us and saying, can you design something that can at least provide an incentive for our key or for this one individual key person to stay. Now, one of the other things also
to somebody walking away from a pension, right? Somebody not wanting to walk away from a pension, they've been paying into the pension for 20 years. Sometimes that's a part of the decision making. They're like, well, I don't want to leave because I've been part of this pension for so long, right? That's that golden handshake.
That's right. So the other advantage with the RCA is they can be set up for multiple people. So if you have multiple key persons, they can one time be set up for multiple, but it can also be set up for individuals. So you could have some individuals in the company that you'd like to set up an RCA for. So it doesn't have to be provided for everybody. It can be provided for those key individuals. Okay. Any questions, or I can move on to a separate?
To the next case.
Okay. Okay, so the next one is a case where you have an executive, where you have the executive who's making $400,000 a year, and again, because we're talking about an RCA, there's no limit on the executive compensation. The only thing with RCAs is the income that is received, it has to be employment income, i.e. T4. So it does include benefits such as the bonuses, commission. What it would not include is income received as dividends. Okay, so that's the key. So as long as it's T4 employment income, then we should be fine. What the RCA does in this case is, as Orlando mentioned, is it removes the tax deductible, the limits that the Income Tax Act puts on the RSP contribution. So the maximum RSP contribution for 2024 is about $31,500. So if somebody's making $400,000, 18% of that dollar amount is significantly higher than the $31,560. In addition, the RCA can be designed to provide significantly higher tax deductible dollar limits beyond the 18%. So the RCA can be set up as I won't get into a lot of technical detail, but it's a different plan design where the contribution rate, the 18%, it varies by the age. So the older you get, the higher those rates get, the higher the contribution is, and it can be significantly higher. So that's one of the advantages. What it also does is it allows for retirement equity for your senior executives. So, normally what we've seen is some of the contributions that in total dollar amounts, usually it's for a senior executive, it's, here's your total take, and portion of that or significant portion of it could be put in through the RCA. So that makes it a lot more tax effective of getting that compensation to the executive. Some of it's for current compensation, current usage. The rest of it gets popped into the RCA. The corporation still gets full tax deduction, and the member isn't taxed on it until that money comes out at a later date. One of the other areas of interest with the RCA is what we've seen it is also used as in lieu of a severance. So if there is an executive that they're looking at, and you have to roll out a significant dollar amount to that executive, what we've also seen is RCA set up at that point in time or popped into a regular RCA. So, the executive is being paid out $400,000 or $500,000 of severance. If that's paid out immediately, it's immediately taxable. With the RCA, if that money can be popped into the RCA, then that amount, the corporation still gets that tax deduction. That member can then roll that money out over 4, 5, 6, 7 years by being at a much lower tax rate, especially if they're getting into retirement or getting close to retirement. Another advantage from a tax planning perspective is, unlike the registered environments of RSPs, where you are required to start receiving money out of the RSP by age 71. Money coming out of an RCA can be delayed past age 71. So if you are doing some tax planning, you have other assets that you're living off of, and you want to delay receiving the income from the RCA past 71, that can also happen. That can also occur.
Munir, a question that came in.
Okay.
How does the RCA compare to, let's say, a supplemental executive retirement plan?
Great question. It's two sides of the same coin. So the supplementary executive retirement plan is a plan structure. RCA is usually the funding vehicle of how you're going to fund it, right? So normally those terms can be used interchangeably, but normally what the SERP agreement will do in a lot of supplementary executive retirement plans are not funded, right? So they'll be funded, either they'll be funded through on a pay-as-you-go basis. Oh, sorry, when I say not funded, they're not pre-funded. So they'll either be paid on a pay-as-you-go basis, which basically means the company's not putting money away as the person is earning the benefit. They just start paying the benefits as the person retires or they come due. Or it's funded through a letter of credit, which basically they'll go out and get a letter of credit from the bank to guarantee that, something happened to the company, and the bank would then kick in the dollar amounts required. So if you're looking at it, it's basically RCA is the funding vehicle. So if the company doesn't put the money away into an RCA, they don't get the tax deduction, right? And as an individual, if the money isn't in the RCA, the risk that you run is if the company goes belly up, then the executive who's part of that SERP just becomes a general creditor. Whereas if the SERP quote has been funded through the RCA agreement, then the money is out of the company inside a trust fund. So if the company does go belly up, your benefits are at least funded.
Got you. More protection for the employee. Where that money got? Okay. I'm sure there's probably some more that we might be able to go sort of deeper with an individual. But
sure.
Yeah, I think that was very helpful.
So I'll move on to the next slide. So business sale, intergenerational transfer. So here's another area where an RCA can come in really, really handy. So, if you have a business, and I'll just use some numbers here, say it's $3 million, and you've been taking out T4 income out of your business for a number of years, and you're transferring that business to your kids. So $3 million capital gains. If you're the only sole owner, sole shareholder, you've now got even if you use the lifetime capital gains exemption, now you got $2 million of capital gains. So one of the things that the RCA can do is if you were to set up an RCA before you did the transition, what it automatically does is it may create, depending on the T4 income and the number of years you've had, it could easily create $1 million, $2 million of, quote, tax-deductible contribution room for the corporation. So it allows you to do two things. Either the company can then fund that RCA for your retirement, which lowers the cost. So if you have the investable cash in the corporation, you fund the RCA, so all of a sudden your company's worth $2 million less, especially if you're giving that to the next generation. That means your capital gains are now down to $1 million. And then you can retire and start withdrawing some of that money down the road. So the cost of the business goes down. The other way that can also happen is the RCA could be set up. It hits the balance side of the balance sheet side where you got a liability. Again, it lowers it, i.e. the company has to fund the $2 million benefit. Again, the cost of the benefit is lower. You retire, the next generation, your kids could be running the business. Your benefits are, say, I'm just going to use a number, say $100,000 a year coming out of the RCA. They can now start funding the RCA from future contributions where the $100,000 funding into the RCA is fully tax deductible to the corp, and then you'll be taxed at your average/marginal tax rate as the money comes out of the RCA. So it allows, even at the intergenerational wealth transfer session, or if you're selling your business, if you're doing an asset sale, significant dollars may come into the company, and that would cause significant taxes to be paid by the corp due to the income that year. If an RCA is set up and it does have this tax-deductible contribution room built in, that money could be taken and put into the RCA and get a full tax deduction. So the corporation is not paying the 26 and a half. Sorry, those are Ontario rates, say 26.5% corporate tax rate. So those are a couple of different ways. It can also be done on share purchase. There are some nuances there, and we'd be happy to, Orlando and I would be happy to sort of connect with you one-on-one if you had any questions on there.
Yeah.
Sorry, go ahead, Orlando.
Yeah, no, I was agreeing with you.
So one of the other things, one of the other areas that has happened where, you have a corporation, and it's not necessarily on a sale or intergenerational transition, but you have a corporation where you've built up significant investable cash inside the corp. And one of the things that you're being hit by is a passive income rule, right? So in other words, you're realizing, if you're a small business, you're paying up to 12.2% tax rate in Ontario for the first $500,000. Now that you've got, you've been running the corp for a while, you've got investable cash that you've been investing within the corporation, and all of a sudden your realized passive income is in excess of $150,000 that year. Yeah. Your tax rate for the active income jumps to 26.5%. What the RCA can do is if you do create that room, you can move that cash into the RCA. So suppose you put in a $1.5 million in, you have that investable cash within the corporation, now it goes into the RCA. Now, within the corporation, you don't have that realized income because you moved most of that cash in, or a good chunk of that cash in. So your active tax rate comes down. Now, if you only had an income of, say, $300,000, that would create a significant loss for you in that year. One of the advantages of this process is you can actually take that loss that you've created and you can go back 3 years and recover any taxes that you had paid. So in other words, if you had a really good year, 1 or 2 years ago, you now have the ability, if you were able to create a loss this year, to go back and try to recover some of those taxes paid. Or if you don't have those losses, then you can actually carry forward the loss for 20 years. So you can just keep on writing off, not having to pay taxes in the future. So that's one of the
taxes, Manair. There's a tax question, and we'll probably open up for Q&A. Somebody was asking about the withholding tax. So on the way out, can you speak about on the way out of the RCA, the withholding tax?
Right.
How that
so it depends on whether it's whether you're doing a lump sum or you're doing a retirement, right? So it'll be, so if you're doing a regular retirement, normally, if you get the rates, I think if it's below $5,000, it's 10%, and above it, it's 30%. But at the end of the year, that's just the withholding tax on the amount going out. But at the end of the year, you're going to file your tax return, and based on whatever your income is, if they've taken out too much taxes based on the 30%, you're going to get it back, or vice versa, right?
I'll probably
but anything coming out of the RCA is a regular income.
Yeah. I'll ask one more from the Q&A section here, and then I'll open it up. People can raise their hands and ask.
Sure.
One other question was, who starts the process, in terms of the conversation with the employer? Does one, approach the company and suggest it? What do you normally see? And then we'll open up for general Q&A. What typically do you normally see? Does the employee, if they're working for a company, can they approach the employer to bring it to their attention that they're interested in this?
Absolutely. I mean, we've seen where, with regards to the executives, because it's a lot more tax effective for the executive, right? So if they're making $400,000 a year, right now anything over for 2024, I think it's $240. Anything that's slightly over $240,000, it will be in Ontario will be taxed at 53.53%. So that's another way of, if you have an RCA and, taking that money and having that popped into an RCA, and that can be used for your retirement down the road, and it's just equalization, yeah, it's a significant tax opportunity, a tax savings opportunity for the executive. Now, with regards to the companies, a lot of them don't have an issue. It's just from the company's perspective, it's a more tax-effective way of providing compensation to their senior executives. Right, but it's in that case, yeah, we do see a lot of executives in that case approaching them and saying, look, it's what we're looking at. It'll make a big tax sense for them to do it. Now, the funny thing is, Orlando and I were speaking before, just a recent case where we got a call in from a potential client, went through it, and I said, well, you're going to have to get, I said, the biggest thing here is you need to talk to your employer to set one of these plans up. And the individual started laughing, and he said it was the employer who told me to go and set it up because he thought I was paying too much taxes. So some employers are aware of it, and they will set them up.
Yeah. So either way is fine. So I'll open up if anybody else has a question. I'm just looking at the time in case anybody needs to wrap up their lunch hour. It's 12:45. There's a raise hand feature, so you can raise your hand and I'll unmute you. So you can ask Munir and any other question that sort of came up, but appreciate that questions were also put in the chat as well. Let me see if there's any other one that might be in the chat. Okay, I will continue to keep an eye on that. Let me see. But definitely glad that some of the questions came on the earlier end. And I think one thing we didn't get to touch on is sometimes for corporations that are not large corporations, but it might be an individual that is incorporated, right? So they could also, they're the only owner for the company, they're the only person inside that company, they've just incorporated themselves. Because of that, they could set one up as well for themselves.
That's correct. So I think the last case study we had was, it's instead of the executive, it's set up for the owner themselves, right? So in that case, again, the same situation where the corporation has a lot of money inside the corp, say a physician or a lawyer, and you have investable cash inside the corporation. It's a nice way of getting the cash out. What we're seeing is more and more accountants now, where the funds are now being initiated by accountants because they're sort of looking at the passive income rule and saying, look, there's a lot of tax paid. How can we sort of set up a structure to minimize or reduce the taxes that the corporations are paying because of the passive income rule? So again, that creates this facility of moving it out. So if you professionals, it can be set up for lawyers, doctors. The newest, another area that's been recently available, we can incorporate our real estate agents, right? And some of them will have significant earnings, and they can now set these plans up with regards to taking advantage of the tax situations.
Yeah. All right, and let me just take another quick look at any hands. And while I'm doing that, I wanted to definitely give everybody a heads up that the next webinar is going to be February 15th. Shifting gears, looking at retirement elsewhere, focusing on Portugal, just as a continuation of, this is the third time we're doing a webinar on this topic. So certainly, and even for this topic, there are more details we could get into because you sort of know that there's 4 different scenarios, and each of those requires touching on a little bit more details. And we always like to work with an accountant or the person's accountant to explore if this can be used. For those that are accountants, certainly, you may have somebody that this could actually help. Myself or Munir, happy to sort of go on a call and then just to sort of help brainstorm and strategize, right? So, as we get close to the hour mark, I'm hoping that one of 2 things came out of this. You either became aware of something which it might have been the first time, or it could have been that it wasn't your, you've been aware of it, but maybe now to a different degree, right? And this can allow you to do a bit more research. There's not a whole lot of information out there on it, and it's something that is, it is part of the Tax Act, but it requires multiple professionals collaborating together, right? So there's an element where to determine what can be put towards the RCA, the skills of an actuary, such as voir dire, is required, right? Working with an accountant, a lawyer. So there's a number of moving parts, and that might be some of the reasons why, unlike a very generic standard, Big Mac, you don't really see these around because it's gourmet. It's a gourmet tax vehicle. But what we're trying to do is to at least make more people know that it is an option, and not saying that you should, but we want to know that you can, you potentially can. And if that's the case, well, let's talk about it, because it's better to know about it sooner rather than later, right? So that you can take full advantage of this. So let me take one more look at the time, and if there aren't any other questions, I appreciate people joining on their lunch hours. It's the very first time I've done one of these webinars midday. I'm usually doing them at the end of the day. We'll use the full hour because I know people are not sort of running off back to head back to work. But because I know it's in the middle of the day, I want to respect everyone's time, and even if you get a little bit of time to finish your meal if you are still having lunch. So with that being said, I think that might be it. The only other thing I would say is don't hesitate to reach out, like I mentioned earlier, to myself, Munir. Would like to see you join some of the other webinars that are happening for 2024, the next one being in February. And share with persons in your network, because again, the whole idea of this is to really share information so that you can be empowered to make informed decisions, right? And then to execute. So the knowing is one, the doing is the other. All right. And that's what we've been trying to focus on here. So have a wonderful day. Thank you for joining, and stay safe. Take care. Thanks, Munir.
Thanks. Bye-bye.
Okay.